We talked about the balance sheet in the first round and a couple other forms, but now we want to dive into another critical financial statement in detail called the income statement. It shows the profits you have once you reduce all the costs out of the whole aspect of it. And then you end up with a net income, hopefully, or a net loss by the time you're all done. Here is the formula, and it looks pretty tough. Revenue minus cost of goods sold equals gross profits minus operating expenses, taxes, in essence, how much money, and then subtract all your different types of expenses. So here's a different layout that I find much easier to understand. Revenue, okay, is the cost of goods sold. Or in other words, what does it cost to sell whatever you're selling? If you're selling widgets, you're selling for $2 a piece, then you go through and you have fixed expenses. In other words, your rent for the entire year. You sit down and you calculate what it costs for each item, and that's the cost of the goods sold. So revenue minus how much that good is, that's the gross profit. But then you take away the operating expenses. You take away the plumbing, the electric, the sewer. You take all that out of there, and then you have the net income before taxes. Pretty straightforward. And then the taxes take that out, and what's ever left over, you have net income or you have a loss. Okay, so really it's revenue minus cost of goods sold minus operating expenses minus taxes equals your net income or loss in the process. 5 different terms that you have to really know for this when it comes down to it. You also have gross profit and net income. So technically there's 7 terms to know on the income formula, but in essence, it's pretty easy. Revenue minus expenses, and calculate all your expenses. And then at the end, you have the net income or loss. Revenue minus cost of goods sold equals gross profit minus operating expenses, net income before taxes, take out the taxes, and then what you have left over is your net income or your loss. That's the income statement formula. It's a little bit different than the balance sheet formula. The balance sheet is assets equals liabilities plus owner's equity. The income statement formula, you don't have to say with a deep voice. So that being said, here is the cost of goods sold. It really is the cost of the merchandise or raw materials used for producing the item for resale. And so by the time you're done, how much the firm earned is the gross profit by buying or selling the merchandise. So and there's different ways you do things. This is called inventory. There's 2 general practices. Technically, there's 3, but for our class, we're going to talk about 2. One is FIFO and one is LIFO. Okay, so FIFO means first in, first out. LIFO is last in, first out. And it depends what you're doing. Almost every company uses FIFO for an inventory method. You really want to have your first in to be the first out. When you go into the grocery store and you're hunting for, let's say, a gallon of milk, you're going through the labels, you want to always sneak in the back and grab the one that has the one that expires the latest date, because the grocer's pushing forward the product with the earliest thing, because they want to get the product out first to make certain that they keep their fresh churning nonstop as they go through. Sometimes it doesn't matter. When you think about copper, okay, there's a famous case of the Anaconda Mining Company in northern United States. They had a giant stockpile where they actually had huge piles of copper ore sitting there for years, decades, literally. There was a huge strike. And what they did is they kept things tracked. So the most recently mined stuff was on top. And then as they went down deeper into the giant mountain of copper ore, it was much cheaper. So the recent stuff had a high price tag and everything else. And so the strike went on and it went on and the pile got depleted. And as the pile got depleted, because they're still selling the copper ore, even though the workers mining it aren't working anymore, they keep on going down. And the copper ore kept on getting cheaper and cheaper and cheaper until finally they're at the lowest level of the copper ore. And keep in mind, they're using LIFO, last in, first out. And they say, we don't have any money, except they're making more profit because of the fact that the cost of the ore is so cheap. They actually got down to stuff that was 80 years old on the bottom of the pile. So it cost a fraction of what the stuff that was originally on top. But the difference was that the miners are still on strike. So they're making profit saying, we don't have any money, we don't have any money. And sure enough, They got to the bottom, they made a lot of profit, but there was no more ore. So they finally got back to work, except for the fact that the company couldn't survive because of the fact that between the new cost of labor versus the stuff that was 80 years ago was so expensive, they went belly up. They use last in, first out. There are cases that you use it where freshness is not an issue. Also, things like gasoline, occasionally they use weighted average on gasoline. You have gas and you mix it all up into a big tank. So what does it cost? This one over here costs $3 and the stuff in the bottom of the tank costs $2. So what is it? You use a weighted average between them. So you have LIFO, FIFO, and also weighted average. But for the most part, the vast majority of business will use a FIFO accounting method. So you also have a thing called depreciation. When you appreciate something, you really like it. When you depreciate, you don't. No, that's not what this means. It means that you write off things in accounting form by a specific percentage. If you buy, let me use an example, $100,000 giant press. You decide to use it 10% straight line depreciation over a 10-year amount. So the first year, the press is asset value is $100,000. The next year, it's $90,000, and you write $10,000 off for depreciation. The next year, it's only worth $80,000 on your assets, and you write off another $10,000 expense. You're depreciating it each year by $10,000 until after the 10th year, it actually has a technical zero value in the assets, but it's because it's fully depreciated. You might use it for years after that, but that being said, you really write it off in a straight line depreciation, reducing the overall amount. So you have to know what depreciation is and know also what operating expenses are. These are the things that are cost on a regular daily basis, usually refer to operating expenses over a 1-year period. At the end, the bottom line is either you have a net profit or a net loss. So revenue is the amount of money you bring in, and the profit is the amount of money that you have after you reduce expenses. Over here is an example of Lonnie. Lonnie took over, he got almost $1 million loan close to it. He purchased a property at the gas pumps. He really focused on organic food. But let me tell you, Lonnie cheats. Because if you look really closely in the picture, Lonnie's selling cheese toast. And I know that cheese toast are organic. Oh my gosh, there is no such thing as a cheese toast tree out there. So be careful. Okay, but regardless, Lonnie is wealthy because he made a brilliant business decision. Now he brings in $11 million annually. What a huge return on investment. This man is a smart business owner, even if he's not selling everything organic. So that being said, what's the difference between the revenue and the profit? The revenue is all the money he brings in, and profits what's after all the operating expenses are taken out. Statement of cash flows, you really want to make certain that you track your cash receipts and how much you spend on 3 major activities: your operations, your investments, and your financing. Keep track of them on a regular basis, because tracking the money you have will help you determine how much money you have in case you have any kind of major crisis or anything else in the organization. So cash flow management is the difference between the money coming in and going out of the business. It's huge, especially if you have an accounts receivable that really is large. You may not have enough money to pay your expenses, but you may have all this money as an asset. So you have to watch what you're doing in the process. So anyhow, by the time you're all done, here's a couple ethical decisions. I'll let you read this because of the fact that somebody, your CEO, says, we can improve our financial statements by treating the strong sales you made in January as if they're made last year in December. That way we boost sales from last year and the CEO looks better. What would you do? It's not ethical. It's a direct violation of the Financial Accounting Standard Boards. What are your alternatives? This might happen to you someday. You might have to sit down and make an ethical decision. And I think you're going to have to sit down and make a decision as to, are you going to be ethical or unethical? And if you're unethical, what are the consequences of it? Can you go to jail? Can you lose your job? Think about those things, because ethics is part of business as well. Test prep, here's the things, the steps from creating an income statement. Know the formula, because that could be on a test. Okay, and then why is the statement of cash flows important? You want to make certain, especially on a small business, that you can evaluate your cash flow to see where you're at. Currently, to make sure you can pay all your bills. An income statement is a movie, a balance sheet is a snapshot. The statement of cash flows is critical for general operating, and cash is critical to small business. and know what depreciation is. Take care.